Okay, welcome everybody. This is for the content for the month of April. A lot of things have been happening in the market of late. So it's causing stress and anxiety. When you have strategies, we can take a pause or we can take a deeper breath, and we don't have to be reactionary. Remember, again, going back to the news, the media, they need something to talk about. And I know there's volatility because one of the products that we offer to our clients are something called structured notes. And when you're getting above average rates of return, it's because of that volatility. And so the June notes just came out at 12.4% for the Euro style. And that is, to me, a pretty solid return based on what I'm looking here in the equities market. So I've been advising a lot of my clients to, as we've talked about in the past, a whole, depending on your allocation, equities versus, say, a bond or an income portfolio, to find bond alternatives. Equities have gotten crushed this year. And then just so we understand, you're going to hear the talking heads, the newspapers, all the news channels and the investment networks talking about a recession. And it's like inflation, right? That they redefine the definition. So traditionally, a recession used to be 2 negative quarters of GDP in a row. And now they sort of moved that target. Well, it doesn't necessarily need to be 2 quarters. It could just be a downward 10 or slow in the economy, a number of issues, housing starts, unemployment, inflation, all these factors. So we have to put our money somewhere. And if we can't time the market, so what I always suggest is have a strategy. If at some point in time the winds are starting to change, we can adjust our strategies. So as I look at April, you can see that there's really, except for commodities, and commodities are oil, which we all now see at the pump, where last year during COVID, it was the worst place to be. They got crushed. But now it's been, getting better. But now they turn around and they've cut off our supply here. We're shipping it overseas. We're going to just have a trickle down effect. But from an investment standpoint, commodities and futures have done okay. But everything else, if you don't sell today, you have not experienced a loss. So April was not a good month. So far, 2022 has not been a good year, right? And so that's evident on this chart, right? If you look, and we're going to go light blue, right? Small caps, the small business arena is taking it on the chin. So where it was holding its own last year, it was starting to recover. It's the backbone of America, in my opinion, right? It's the mom and pops, right? You're not your big blue chips, established corporations, but these are your, 50 to 500 size companies that are employing people, trying to make a living, that right now they're tightening their belts. And if you had money in these types of indices, they got hurt. And then as the colors, I'm going to start from the bottom up, right? So that blue is small caps. The purple, right, is the S&P. That used to be our red S&P. So big chips, right? Your big boys and your small caps got hurt. And then the pink is emerging market. So I always refer to this. They kept this color in the same, which is China. Right now we got the neon green. Right, so that's your euros, right? So established European nations. And then we get into our solid green here. This is real estate, which for the year has not done well. And you're going to hear a lot of conflicting opinions on whether real estate is a place to invest. Are we buying a house, or are we buying REITs? Is there enough housing in for the public, or are interest rates slowing housing? Right, you got a lot of conflicting data out there, and that's why you just have to have strategies, but understand the information as it's being conveyed. And then lastly, you have the industrial average, right? So everything is down for the years. And it's probably, if you look at your 401k, your IRA statements, your brokerage statements, this is reflective of that. Again, commodities have done well, but again, it's the cost of oil because it's heavily oil weighted. So when we look at our chart, we can say, hey, we still don't have a red line. We're really close, but it hasn't rolled over yet. But everybody that I'm talking to is suggesting that recession will actually be enforced by, I would say, by the end of summer, right? So by the end of the summer, once people, we got Memorial Day weekend, right? You're going to have people starting to travel, costs are up. That would sort of be telltale. But as we start to head into these, third quarter, fourth quarter of this year, I will say that we start to see a slowdown in the economy overall, and you could see that red line right now. So now we get into the income area, right? So the income area, and this is, a lot of people that may be on this call might not be necessarily impacted by this yet, right? But I always say this, that if you had retired and you had $1 million portfolio, and the person that designed the portfolio said, oh, yeah, the 4% rule, you're going to get 4% of your portfolio, which is 40 grand, which you needed to live on, not including Social Security. Well, your portfolio, look at the pink here. The pink is 20-year treasuries. That's safe money, which was the cat's meow last year. Everybody was flight to gold and to short-term and long-term treasuries. So the 20 years here have gotten absolutely crushed. So the federal government is not the place to go right now. And now we got 4.5% loss right here of your, let's look at these. These are high yield corporate bonds. High yield, another word for junk, right? So you got, okay, so where people were trying to get that return on investment, they have actually lost money now in their overall bond portfolio. And as I've always said, bonds don't like rising interest rates, which we've all seen now because the Fed has started to increase and aggressively tick up their interest rates and borrowing costs. Well, bond portfolios are starting to take it on the chin. And if you were in an income portfolio, you're probably getting decimated right now. And then, as we continue, -4 here for the 7 to 10 year treasury. So again, the Fed and the federal government isn't the place. The strong green are high yield munis. So again, high yield, although municipals, which are typically your states, your municipalities, right? Let's say Grand Rapids, Michigan was close to going belly up at one point. Now, nobody has gone belly up on a muni ever yet. No state has, but some cities have come close. But the point is that if you put all your money, and typically they're for high net worth clientele or munis because they're sold on the tax favored treatment. Well, what do we care what the tax favored treatment is if our portfolio on $1 million just lost $40,000, and now I can't take out that $40,000 that I needed to because now I've locked in the loss on that. So again, from a strategic standpoint, we have talked a lot about bond alternatives and what to do in this environment. So now we go to the purple. We got our aggregate bonds. This is US bonds here. It still got hurt. And then our greens here are our total international bonds. These are developed countries. And then you have this here is at least your state bonds, muni bonds. So they've done a little better, but everything, if you were in an income portfolio following traditional wisdom, 60-40, 50-50, or even 70% bonds, 30% equities, because you want to take less risk, your portfolio has lost a significant amount of its value. Now, when we look at for year to date, it's even worse. Now, I'm not going to beat a dead horse. I've made my point. I will continue to keep an eye out. If I thought this was a safe place to go, I would say, hey, we need to step back into this arena. But I have just said, listen, interest rates will continue to tick up. Bond portfolios will be challenged on a go forward for next year to 2 years. So 12 to 24 months, we need to be careful there. And then, as we look at it, again, we don't have the crossover yet, but there's a lot of pressure here, oversold right here. So we could see a upward tick in some of the values. It doesn't mean it's all gloom and doom. All right, so I just went through that really quick, but the one tool that now Brookstone has that we got from Formufolios is the recession probability analytics tool. And it takes 100 data points, it measures them, and that red line, that red arrow here is 50. That's your median. If we're below that, that means that a recession is not probable. So right now in the immediate future, in the next month or two, not here, but it has ticked up from 31 to 33. Keep an eye out. We're going to continue. If you would like to see if there are strategies that you can implement to reduce some of this volatility, some of this risk, get with me after this call. I'm happy to share with you ideas. So here are disclosures, right? Brookstone Retirement Wealth Academy's advisors makes me put that up there. And then lastly, here's my contact information. If anybody on the call has any questions, happy to help. But again, I want to thank each and every one of you for taking time to hop on every week, and we will continue to do so. So have a great day, have a wonderful holiday, and I will talk to you next week. Bye-bye.